When most people think about saving money, the first thing that often comes to mind is opening a savings account at the local bank. It's a lesson drilled into us from a young age. Save what you earn, keep it safe, and let it grow with interest. But when you look at the financial habits of the wealthy, a surprising trend emerges. The truly rich rarely keep their money sitting idle in a bank account. Instead, they follow a very different set of principles to grow and preserve their wealth. But why is this the case? What do the rich know about money that makes them avoid traditional savings accounts? Let's explore the reasons behind this seemingly counterintuitive approach and uncover the strategies that set the wealthy apart. First, it's important to understand the fundamental difference between saving and investing. For many, a bank savings account represents security, a safe place to store money with little to no risk. However, the trade-off for this safety is often minimal returns. The interest rates offered by savings accounts are typically very low, often not even keeping pace with inflation. Inflation is the gradual increase in the price of goods and services over time, which means that the purchasing power of money decreases each year. If the interest earned on a savings account is less than the rate of inflation, the real value of that money actually goes down over time. In other words, even though the number in your account might grow a little, what you can actually buy with that money shrinks. The rich are acutely aware of this dynamic. They understand that to preserve and grow their wealth, they must seek out opportunities that offer returns greater than inflation. This is why they typically avoid keeping large sums of money in low-interest bank accounts. Instead, they put their money to work in assets that generate higher returns, such as stocks, bonds, real estate, private businesses, and alternative investments. These options carry higher risks than a savings account, but they also offer the potential for much greater rewards. Another key reason the rich avoid stashing cash in the bank is the concept of opportunity cost. Opportunity cost refers to the potential benefits an individual misses out on when choosing one alternative over another. For example, if a wealthy person keeps $1 million in a savings account earning 1% interest, that money could be earning 5, 10, or even more percent if invested elsewhere. Over time, the difference in returns can be enormous. The rich view every dollar as a tool, a resource that should be actively working to create more wealth. But it's not just about chasing higher returns. The wealthy also use their money strategically to take advantage of leverage. Leverage is the use of borrowed money to increase the potential return on investment. Let's say a wealthy investor wants to buy a piece of real estate. Instead of paying the full price in cash, they might put down a portion and borrow the rest, using the property itself as collateral. If the property increases in value, the returns on their initial investment are multiplied. Banks, in turn, often lend more willingly to those who have a proven track record of investing successfully. This creates a virtuous cycle, where smart use of leverage opens up even greater opportunities. Additionally, the rich understand the importance of liquidity and flexibility. While it's true that a savings account offers easy access to cash, the wealthy often maintain just enough liquidity to cover their short-term needs and emergencies. The rest of their money is allocated to investments that might not be instantly accessible, but are working hard to generate returns. If they do need immediate funds, the wealthy can access credit lines or liquidate certain investments quickly, often with more efficiency than the average person can withdraw large sums from a traditional savings account. Tax efficiency is another major factor. Interest earned from savings accounts is typically taxed at ordinary income rates, which can be quite high, especially for those in higher tax brackets. In contrast, many investments, such as qualified dividends, long-term capital gains, and certain real estate profits, are taxed at lower rates. The rich employ sophisticated strategies to minimize their tax liabilities, using accounts and structures that maximize after-tax returns. For example, they might invest through tax-advantaged vehicles like trusts, partnerships, or retirement accounts, or use depreciation and other deductions to offset income. Beyond the numbers, the rich often have a different mindset when it comes to money. Instead of viewing wealth as something to be hoarded and protected, they see it as a resource to be deployed. They are constantly seeking out new ventures, innovative businesses, and emerging markets. This entrepreneurial spirit drives them to allocate their capital where it can have the most impact, not just for their own gain, but often for the creation of jobs, products, and services that benefit society as a whole. Moreover, the rich understand the value of diversification. Rather than putting all their eggs in one basket, they spread their risk across a variety of asset classes and geographic regions. This way, if one investment performs poorly, others may balance out the loss. This sophisticated approach to portfolio management is a far cry from simply depositing money in a bank account and hoping for the best. There's also the matter of legacy. The wealthy often think in terms of generational wealth, building and preserving assets that can be passed down to children and grandchildren. Leaving money in a bank account doesn't provide the same growth potential or tax advantages as setting up trusts, foundations, or other vehicles designed specifically for long-term wealth transfer. Finally, it's worth noting that banks themselves don't just keep your money sitting in a vault. When you deposit money, the bank turns around and lends it out to others at the higher interest rates or invests it in various assets. In a sense, the bank is putting your money to work for its own profit, while paying you only a fraction of the returns. The rich prefer to cut out the middleman and to make those investments themselves, capturing the full benefit. In summary, the reason the rich never save money in the bank comes down to a deep understanding of how money works. They recognize the limitations of traditional savings accounts and instead focus on maximizing returns, minimizing taxes, leveraging opportunities, maintaining flexibility, and building lasting wealth. By thinking strategically and refusing to let their money sit idle, the wealthy are able to grow their fortunes, protect against inflation, and create legacies that endure for generations. For those who aspire to follow in their footsteps, the lesson is clear. Don't just save, invest, diversify, and let your money work as hard as you do.